Morning, everybody. Thank you guys for tuning in to watch with us today. I am Matt Carson, our Vice President of Sales here at Senior Marketing Specialist.
And I'm Jalen Jackson, the Key Account Specialist and Compliance Officer here at Senior Marketing Specialist.
And today we are going to talk through something we've been honestly having some version of this conversation since last probably February and kind of rolled it out to agents around April or May of last year. But really kind of going through the state of the industry, leading in this last year and a half and kind of what we see coming a little bit into the future with the most up-to-date information we have as close to AEP as we could get it, because while I mentioned this topic's been going on for a long time, it's rapidly evolving and more things get added and changed along the way. So I wanted to bring you guys the most up-to-date version of this that we have of what we think is happening right now, what we expect to see this AEP, hopefully some very good solutions to make sure that you guys do have a great AEP, and then kind of leave you with where we think things are going to continue to be headed. So, Jalen, you definitely are our pulse of the industry and everything going on. So I always lean on you for all of the reasons and all of the things behind the scenes. We joke all the time about you reading long CMS documents and things in your free time, and I'm like, I really love hearing what you have to share about those, because I am not going to be reading all of those. So
not for everybody.
let's kick us off with what is kind of leading us into this AEP. What are we expecting on both the Med Sup and MA front right now?
Yeah. So not to beat the dead horse that was last year, but I want to talk really a little bit about how we came out of last AEP, because that should really inform a lot of decisions about going through this year. First thing we've got to realize is we saw 1.8 million non-special needs plans service area reductions, huge number of people losing coverage. We had a lot of opportunity, a lot of agents coming off their best AEP ever. But if we look at the data, our friends over at Deft Research shared some really interesting numbers recently, and it gave us an idea that maybe there is still room for improvement, because what we know is over the last 10 years, that number of people that have original Medicare only, no MA, no Med Sup, no group plan, just original Medicare, it's been downtrending steadily for the past decade.
Yeah.
But what we saw this January when we got the new data from CMS, which wasn't actually until March, but it was the January data. But when we got that data, we saw all of a sudden there was a jump of almost 500,000 people into that original Medicare only bucket. Now, there's a couple of conclusions we could draw from this. One, we could say, well, people suddenly decided original Medicare with no backup was the best deal on the market. And I don't think for a minute that that's true.
Probably not likely, yeah.
So what I think happened, and I think we can all agree, is 500,000 people woke up on January 1st with no health insurance that were not expecting that.
Of the 1.8 that were losing coverage, meaning 500,000 didn't get what they needed.
Exactly. So 500,000 folks just didn't get a chance to talk to a qualified local licensed agent. They didn't get the assistance they need. They didn't read their ANOC. They didn't somehow see all the TV commercials and radio ads, or they just didn't care. But at the end of the day, we had a lot of folks that came out of AEP with no coverage. And I really want that to inform the rest of this conversation, because we're seeing more of that going into this year. But let's start with Med Sup.
Yeah.
That has been a big pain point for the past couple of years.
Yeah, I think that kind of I'm trying to think the right way to say downhill trend maybe in that market started even before what we've seen the last year or so for Medicare Advantage. That kind of kicked off this last 2 or so years of what's happening.
Yeah, absolutely. I think when we look at the Med Sup market, Matt, we look at all of these various factors that are contributing to what we used to consider a crazy rate increase was if it got into double digits.
No one would take a double-digit rate increases. How many 9.9s did we see throughout the years?
I mean, I can remember conversations in this building. That company will never take a double-digit rate increase. They won't allow that to happen. It's bad for their brand. Listen, sometimes the math just doesn't work, and that's where we're at today.
Yeah.
We're at a position where the math no longer works. We're seeing a drastic increase in rates of claims, and that's across the entire industry, not unique to Med Sup, not even unique to Medicare. Claims and payer utilization is higher than ever.
Yeah.
We're also seeing a change in how services are being billed. As we're going to talk a little bit about V28 going into the MA part later, but as we've changed how we bill for services, how we code those services, there's a bigger chunk of services being billed to Part B services, which means more exposure for those Medicare
Yeah.
supplement carriers, especially on
And uncapped exposure. We're
uncapped
not talking about
exposure.
on the Part A side,
Absolutely.
exposure, but it's at least capped. It's, fixed
Absolutely.
amounts versus just coinsurance that's indefinite. Yeah.
Exactly. So you've got more and more utilization, and we're also seeing a change in who is most expensive for those insurers. Traditionally, we think about our older clients that they have the falls, the scrapes, the bumps, the surgeries, the skilled nursing stays, all of those things that cost a lot of money, undoubtedly. But what we're seeing more and more is as we've seen shifts in care where a lot of common things like knee replacements, other musculoskeletal disorders are being treated on an outpatient basis. So they're now falling under Part B
Yeah.
instead of Part A. And a lot of these folks in this turning 65 bucket, which I would really say is like 65 to 69.
Yeah.
Folks that are new to Medicare, either coming off group or aging in, those folks are delaying care.
Yeah.
They're waiting until they're off that group plan with the $4,000 deductible and $10,000 out of pocket, or their ACA plan
Yep.
that's even worse. And they're
Well, because
saying,
they've heard forever, you just get on a plan G or a plan F and it's
yeah,
covered. You don't have to pay anything.
accept your premium.
Right.
And I don't want anyone to think that that's an overwhelmingly bad thing because, we talk about it a lot. If you've seen any of the disruptions webinars that Olivia Richardson and I have done with Ted Sims and Chris over at Niche Loss for Integrity, people buy med sups because of that stability.
Yeah.
The absolute worst thing that can happen to a med sup is your premium will go up.
Right.
That's it. That's the only downside is your premium can go up.
Right.
And if you can handle that, it's still one of the best deals
You
on
still
the
go
market.
wherever you want. You still don't have to deal with prior
Absolutely.
authorizations most of the time. And I know you might have a point on
Yeah,
that.
yeah.
Some small changes happening there. Yeah, no, I totally agree. Making sure that people really understand what they're buying is not that
Mhm.
premium. What they're buying is the the hassle-free premium experience you get with a med sub.
Exactly. Yeah. Never have to see a bill, never have to do anything. Just
Yeah.
pay your premium and you're good to go. That's definitely the buying tactic for a med sup.
Yeah.
But now, obviously, because that utilization, because that changes in billing, drastic rate increases. 30% is not remotely uncommon. We've seen a couple 40. I
40s.
don't think I've seen anything over 40.
I don't think I've seen it go over 40, but that's a wild statement.
But for those of you watching this who have been in the industry for a long time, like those are long-term care rate increases,
Yeah,
right? Like you
totally.
think about, the heyday of long-term care in the 90s and then now going into, I've seen 40, 50, 60% rate increases in that market.
Yep.
So it makes us a little nervous, but there's reasons behind it.
Yeah. Yeah, I mean, I think the biggest thing I know we talk a lot about is the fact that turning 65 consumer now is,
Yeah.
some of the worst loss ratio for the carrier.
Absolutely it is.
So where we had seen, longer term rates, someone who was 75, 80, they'd experience rate increases by the
Mhm.
time they get there. We're continuing to see new options enter the market
Yep.
with, or, maybe artificially low turning 65 rates because those carriers would come on and they'd grab all that
Yeah.
healthy T65 business. Now that we're seeing the opposite of that, you don't have that kind of new healthy lives
course.
buffer to bring that risk pool down. So we're now seeing the consequences
Yep.
of that, and we're seeing the lack of new entrants also.
Yep.
Almost nobody's rolling out new paper anymore on med
Well, and I
subs.
think there's a lot of reasons behind that. We're going to talk next a little bit about the kind of expansion of guaranteed issue in MedSup. I think that's a great place to go from
Yep.
here because I think there's a double-edged sword there. Like what we know for a fact, if you're in a state with a birthday rule, an anniversary rule, year-round guaranteed issue, some of these kind of in-between schemas that a lot of states have been cooking up. There's almost 20 states now that have some kind of expanded guaranteed issue above and beyond the federal requirements. Every single one of those states either is or will be, once they implement these new rules, experiencing larger rate increases, lower plan choice. It's not good for the market long term. Now, the other side of that coin is if you look at a market where we know that new to Medicare demographic is the most expensive for carriers, if you're in a non-birthday or anniversary rural state, it makes it really hard to roll out a new product in that state because that's going to be a huge chunk of the business you get.
Yeah.
You're not going to be just underwriting 90% of your business. It's going to be new to Medicare business with a small chunk of
Right.
underwritten and guaranteed issue coming off group, things like that. So there's definitely, for a carrier, it's a really fine needle to thread to find a price point that makes sense for the market, but also allows you to be profitable. Because if we can't get that profitability in year one, on a med sup, it makes it really difficult to have any kind of staying power.
Yeah. Yeah, I was gonna say, I mean, I know loss ratios in general, I would say, are at least on average, maybe 5 points, if not closer to 10 points higher than they were a decade ago when you're looking at
Absolutely.
med sups. I mean, I know, back in the days, it was very much they wanted to be in the high 60s, they'd settle for low to mid 70s. Now, I think most carriers would kill for low to mid 70s. Most are
Oh,
running upper
most would.
70s, if not well into the 80s, sometimes deep 80s
Yep.
on major carriers, and we've seen small
We've seen
carriers
some
with
crazy ones.
deep triple
Well,
digits.
and I think that's interesting to mention because not even small carriers, but maybe a large carrier. So we won't name names, but we see a lot of carriers that maybe they roll out a new block of business every few years. That's a
Mhm.
common pricing strategy. We
Yep.
roll out a new block, we can cut that price a little bit, and we can downshift our rates to become competitive again. Maybe we've taken a few reasonable rate increases and we're just not in the mix for new business. Open up a new block, downshift those rates. And that's great as long as you can get to an economy of scale really quickly. But with what we see in the market right now, we saw a carrier in Colorado, block of business on the market for about 2.5 years, 459% loss ratio.
Yeah.
Now, here's what people need to know about that: 2,800 people on that block of business. That doesn't mean that all 2,800 people were sick. I think what people need to understand is 2,800 people to get to that 459% loss ratio, that takes 25 people getting cancer.
Yeah.
That
Takes a
takes
dozen on
10 people
ESRD.
getting
Yeah.
ESRD. Yeah,
Yep.
it doesn't take everyone on that block of business being really sick. When you
Yep.
have that small of a block, it takes a handful of really high claims
Yeah. Yeah. I mean, you
experiences.
get 20 or 30 under 65 disabilities that are very high claim and tanks the block. Hence why we see carriers
Absolutely.
do everything they can to discourage some of that business.
For sure.
Yeah.
So as we see that, I want to go back to the birthday and anniversary rules for a little bit, just because those are such a huge issue in our industry. We've
Yep.
seen just this past year 6 new states take those on. A couple where they didn't quite make it across the finish line, but these really are incredibly damaging to the industry. And honestly, there's not really a clear winner in the long term here.
Yeah.
Nobody really wins. So I can tell you where it's coming from. Typically, there's a lot of lobbying for this. Part of it is states' frustrations. I will admit that states are getting very frustrated with CMS, with HHS regarding Medicare Advantage. They're hearing from their constituents and their hospital groups and some of these other people, hey, MA has these network issues. They're
Yeah.
constantly fighting
My
with the
plan
hospital
changes every
groups.
year. Yeah.
Absolutely. So they're constantly hearing that from their constituencies, and there's not really much they can do. They've got those handcuffs of state versus federal
Right.
jurisdiction. So they've got not much that they can do about it. But what they can do is work on the med sub market. So there is an element in most states that have pursued this where there are people highly invested in making the med sub market more accessible to
Yeah.
people, not necessarily more affordable. A lot of times it's pitched that way. Oh, you've been on your plan for 15 years. You've taken
You
rate
can move to this
increases.
plan
You're
that's
on a
$80 a month less without having to go through any
absolutely.
underwriting
And you can do that. So it's a
right now.
political win. Yes,
Yeah.
exactly.
Yeah.
It's an easy political win because what politician doesn't want to stand up in front of their state house and say, I'm making care more affordable for people on Medicare and I'm going to give
Increasing
you more
accessibility,
choices.
more. Yep.
Absolutely.
It's a
Like
good
it's a good
short-term talking
political
point.
win. It
Yeah.
gets a lot of people reelected. It really does. But long term, even short to midterm,
Yeah.
what we know is just over that first 5 years, we see, and I know I've seen some great numbers from some of our friends in the industry, but ballpark, plan choice goes down by about 30%. Rates start going up about 40% faster than they do in non
Yeah.
birthday and anniversary
The
rule
lack of
states.
choice, I think, is going to increase also,
Mhm.
honestly, because where historically we'd had basically 3 birthday or anniversary states, and then maybe 3
Yep.
or 4 other some form of GI states. Carriers just avoided a couple of those
Yeah.
states, or the big carriers. It was important enough a lot of times of their brand to be everywhere. They were like, we'll be there if there's only 3 or 4 of them. We might take some
Certainly.
losses there, but like we're a big national brand. We don't want to not be in this state.
Absolutely.
When that becomes 20 states and it's now close to half of your business, you can't afford to make that same decision.
Mhm.
So we're seeing tons of carriers now that are just saying like, we're just not going to play in those states at all, or pay near zero commission of like, we'll be there for consumers. We need to have the brand, we need to have a product there, but like we don't actively actually want the business there. We just don't want the downside of looking like we're not in the state.
Absolutely.
Yeah.
So I think there's a lot of opportunity still, in some of those states, there's great opportunities to continue to underwrite business when applicable.
Yeah.
If we can save somebody some money, let's save it today, not wait for their policy
Yeah.
anniversary.
I like
There's
the
a lot
90
of
days out.
chances.
We've seen
Yeah,
agencies doing that, booking their annual reviews 90 days prior to their anniversary or birthday window there, shooting for that underwritten plan, and then, kind of coming out of that with two plans. Like, here's the rate we're going to give you with this particular carrier if you can approve through underwriting. If not, we've already got this one in the chamber. And if,
yeah,
60 days from now we can't get that, you've still got your right to move to that plan there. But we're going to try to
absolutely.
save you $80 instead of $20, or we're going to try to move you to a plan in instead to save you something.
Absolutely. And I
Yeah.
think that's the big thing. Underwriting into plan N, underwriting into a high deductible plan
I think
G. We're
high
getting
deductibles are going to
so
really
much more
start. Yeah.
interest in that. When you can put someone in a $75 a month plan and tack on a $30 hospital indemnity plan and get them roughly the same coverage, it makes a lot of sense for
Yeah.
a lot of people. So just looking at exposure, looking at that client risk profile. Now, I'll be the first to admit if you've got those traditional med sub clients that they buy it because they never want to see a bill, that is not a good solution.
Right.
But for savvy consumers that want the flexibility of a med sub but don't like the cost, there are still options out there that are more profitable for you, save the client more money,
Yep.
and help stabilize the market by spreading that risk around.
Yeah, stabilize the risk, and also I would say are less work for you in the long run. While you may be doing,
Absolutely.
like, yes, you're selling two products, not one initially there. We've looked at, look at what the rate increases look like on high deductible blocks right now. Like, they're not getting the
I
40% rate increases. We're seeing lots of zeros
mhm.
and small rate increases there.
Oh, yeah.
I'm not aware of any hospital indemnity plan in the 12 years I've worked here that's ever had a rate increase. So, you're putting them with two things that are going to be significantly more stable than
Yep,
having to rate chase, whatever standard letter plan
yep.
med sup, or obviously shop an MA plan every
Oh,
year.
yeah. I mean, one of our most popular hospital indemnity plans over the past 5 years, I can think of twice where they either had to drop rates because they
Yep. Or add new
needed to,
benefits.
or they had to
Yep.
increase benefits
Yep.
to hit their state MLR requirements. So there's a lot of
Yep.
opportunity in that space. And yeah, high deductible G is just such a stable block right now. I mean, I looked at, the same carrier that had, 107% loss ratio on their regular plan G had a 7% loss ratio on their high deductible G block. So
Yeah.
that it's a huge opportunity for folks. But
Yep.
that's probably enough on MedSup for now because I know we've got a lot of things we want to
Yes, we
talk
do.
about.
Yes. So yeah, let's think. At this point, if anyone needs to know a ton of details about what's going on with MA and leading to that, we've got tons of content on that. I definitely think we should talk more about what's actually happening this year, but give us the
For sure.
the quick overview of like all these financial pressures. We kind of spoke in terms of perfect storm the other day of like just
Yeah,
so many things aligning. What is that list of things aligning to put pressures on MA right
of
now?
course. So Medicare Advantage has had such a slew of issues over the past few years, and it's such a slow burn, right?
Yep.
Because we're dealing with, blowback from the last administration and some changes that they made, some of the current administration changes, carriers trying to navigate and negotiate that, dealing with how much money's in the bank today to pay for benefits compared to preparing for the future and how that's going to impact their payments. We're still recovering from the Inflation Reduction Act. That was 3 years ago. And we're barely
Yeah.
getting started with what that looks
Right. And I
like.
mean, last year was the big one. Like, that was the by far the largest financial impact year as far as carriers go.
Yeah,
And I think we're seeing the fallout of that continuing into this year. Like, they made their best guess last year. Some were right, some were wrong, some
absolutely.
were right or wrong in the wrong way. And we're seeing a lot of those corrections continue this year.
Absolutely. So, we're seeing a lot of increase in premiums across the country. A huge increase in the national average monthly bid amount, up about 34% this year.
Which was already doubled
Which
last year.
which was already up like it was like up
Yeah.
230% over the year before that. So yeah, so I mean we went from the national average bid amount being, in the $60 range 2 years ago to being up over $200 now. So huge increase in those plan level costs. And on the other side of the equation, we have the Inflation Reduction Act that says the base beneficiary premium that is used to calculate those reimbursement rates has to be artificially lowered.
Which
So right now it's $38.99 for 2026. What it should be is over $75.
Yeah, so almost cut in half of where it should be,
Cut in
which, like
half.
you said, is now determining reimbursement as well for
Yes.
carriers. Yeah.
Not only determining reimbursement, but also determining optics. We saw for the first time ever a carrier or a couple carriers get bids rejected by CMS for standalone Part D plans.
Yeah.
Never happened in program history, at least to my knowledge.
Yeah, well, we've got carriers that have a few states that are holes now because of that
Absolutely.
this year.
So it's a big deal. It's that's a sign to me that CMS is because back in the day we used to price Part D plans and we'd say, well, if a plan's too expensive, it just means they don't want a ton of business on that plan. They still want to serve people, but they're not trying to kick anyone off, but they don't want business on that plan. CMS is now apparently taking the stance of, no, your bids matter because of how they affect this base beneficiary premium and the spread between that and direct reimbursement. So I would anticipate this is maybe the first time we've seen it, but maybe not the last as we kind of go through this. But let's look at the market on the Part D side real quick, because 2 years ago, 2022, 2023, we had over 20 Part D plans on the market, 22, and national carriers. Now we've got basically 3-4 national carriers left. And in a lot of states, we're going to have 10 or fewer Part D plans.
And we're going to talk about, probably 3 or 4 that are actually going to pay agent comp and include agents in the equation.
Absolutely. Yeah. So it is a drastically shifting market. It is, it's a place where carriers aren't making money. Carriers are losing a lot of money in some cases, and they're facing a lot of pressures because therapies are advancing a little bit faster in some cases than payment models. That's what we've seen with like Ozempic, between October 2023 and September 2024, the Part D program, not what carriers paid, not what beneficiaries paid, just what Medicare paid on Ozempic or semaglutide, $15.1 billion. That's a huge chunk of money. That is a drastic expense for a single drug.
Yeah.
And by the way,
that was originally classified by CMS and all of that as a diabetes treatment.
Exactly. We're not even paying for it for weight loss yet. So that's a huge expense. So we're seeing a lot of carriers now look forward to these price negotiations under the IRA that in theory should alleviate some costs, but that takes time. We're just seeing those very first 10 drugs that we price negotiated, the Humira, Jardiance, some of those price applicabilities will be for next year for 2026. Yeah. It will be 2027 before Ozempic really gets that negotiated price and have it apply to plans. So there's still a lot of cost exposure going into this next year.
And now still a few more years of that.
Several more years. And as we look to Part B drugs being up for negotiation starting next year for 2028 applicability, like I said, this is all such a slow burn. It takes forever to get where we're going, but we have to deal with the implications of it today. And that's where things like V28, if you're not familiar, we're on version 28 of the CMS payment models. So they're looking at a lot of different things in this new payment model, moving from ICD-9 to ICD-10 billing codes. So just using a new schema to identify and bill codes. They're also looking at how they track that on the risk adjustment side. And a lot of carriers are seeing that as a huge negative. Real challenge in risk adjustments.
Yeah, I mean, I think what we're seeing that manifest itself with is, in order to get the same level of reimbursement as far as the risk adjustment goes, the carriers are having to go a lot more in depth with their coding and be much more specific, much more detailed, quicker to get all of that filed. So it's, as we get into kind of the solution side of things, that's really or impact side, I should say.
Yeah.
That's really pushing much more to like a value-based care model, return of referrals, and HMO type system, because with a open network PPO, that's much more difficult to get that information and be able to remain profitable.
Agreed. So let's talk about those pressures for a second, because there's kind of a couple big shifts going on in the industry. Huge push for transparency. huge push. This isn't just in Medicare. This is across the healthcare spectrum. Transparency in billing, transparency in coding, transparency in risk adjustments, transparency in prior authorization. These are all expensive problems to fix at the plan level, and they're all things that are having to be addressed pretty simultaneously to meet new guidelines, new payment models, things like that. And all of it is affecting the other big boogeyman for carriers, which is star ratings.
Yeah.
And that has been a pain point for, I would say, the past 4 years,
Yeah.
really. And we're seeing the impact of that, where, just 2 or 3 years ago, we had over 45-star plans on the market. Now we have 7.
Right. Well, and that percentage in the 4+ that triggers the 5% bonus to the carriers there.
Absolutely.
That's really the key number. I thought I had it written down. Yeah, it was over 80% that were in 4-star plans 2 years ago, dropped now under 60% that are in 4-star plans. So that's a huge difference in funding to a carrier. So that's 5% of their total fund for that plan. It's literally just a bonus for being 4 stars. So
and if
that
we
is
look at that,
the single most important star jump. Is that jump from 3.5 to 4 has way more impact even than the 4 to 4.5 or 4.5 to 5.
It does. Well, and if you look at that from a standpoint of beneficiaries, that's almost 7 million beneficiaries that went from being in a 4-star or better plan to being in a 3.5-star or worse plan. That's 7 million people. Now, on the beneficiary side, they may not even experience a huge difference. Like, if we're being honest, star ratings don't cover your insulin. Star ratings don't make your doctor be in network. Yes, it gives the plan more money to play with.
I would say from talking with agents, I feel like that's such a
it really is
second or third or fourth or fifth thing that anyone's ever going to look at is the star rating of the plan. I feel like very rarely comes into the consumer decision.
Yep. Yeah.
But huge impact to the carrier.
Equal 4 versus 5. Sure. Let's put someone in a 5-star plan, but there are a lot of other factors, as you said.
Totally. But huge impact to carriers. And we've seen lawsuits on that.
We have. We saw some winning streaks. We've seen some losing streaks. It's going to continue to be a huge thing because, and I tell people this all the time, Carson, star ratings are very limited in how they actually measure quality of care.
Right.
At the end of the day, a star rating is a gauge of how well a plan can color inside the lines CMS gives them.
Yeah, just let's say much more an indicator of how well you fit the model of what CMS wants to see a plan be than what a consumer is reviewing that plan as per se.
It sets priorities. It helps establish what they want to focus on from a macro policy perspective, how it can help meet the other policy objectives of the administration. So we're going to see a drastic shift. Right now, today, when we're recording this, the 2027 Medicare Advantage technical updates, what we usually call the final rule, is sitting at the Office of Management and Budget right now getting reviewed. So that'll be out by Thanksgiving probably. And we'll start reviewing that for the 2027 changes, including updates to star ratings. So expect more on that later, but there's some other factors going into this, one being the end of the value-based insurance design program. Huge program, ballooned from an anticipated $5 billion a year up to over 50, as we saw plans really heavily adopt these non-health related
utility payments, healthy food cards,
pest control. Yep. All sorts of things that are maybe not a direct health benefit, but improve health outcomes. So this experiment, I think that's one of the big things I want people to understand is this was a demonstration program. This was never intended to be a permanent part of the Medicare Advantage program. Never was it intended to be a permanent part of the MA program. It was a demonstration. It was a model to see if this could work. And it didn't work so badly that they ended it 2 years early.
But now the carriers were using huge amounts of money to provide benefits like this that now gone.
Absolutely. So huge amounts of plans. Now, here's what I would tell folks about VBID. If you're in the D-SNP market, top concern, number one top concern for you, followed closely or maybe even playing field with D-SNP integration. But those are your top 2 concerns right now. Because these are folks that are suddenly losing a huge amount of benefits. Like almost every D-SNP plan on the market is going to look worse next year.
Or maybe scarier, I feel like, is that it may not look worse.
Yes.
It's just now behind the SSBCI paywall, gatekeeper, whatever you want to call it there. That's the scarier part to me, is that someone doesn't see that they didn't lose their healthy food card. They didn't lose their utility payment support. It's just now they have to go through an extra step to get to
Mhm.
it that wasn't there before, and I think can lead to lots of call-ins to carriers
Yeah,
this year
no,
of like,
I think
I
this
didn't know
is
why is this not working now? Why can't I use my card for this?
Yeah, I think this is where, if you're watching this as an agent or an agency owner, this is your year to really dial in on your systems for communicating with clients because
Yep.
this is the single largest compliance risk we have had as agents and agencies that was pre-identifiable since I don't know when.
Yeah,
Like we know this is going to be a problem.
100%.
Any client losing VBID benefits, any client on a DSNP plan, because here's the other thing: it's not just the crazy stuff like the food and the utilities and the pest control and the air conditioners. It's also things like buying down the LIS copays
Yep.
on their drugs.
Yep.
So you're going to have folks who haven't had a copay for their Part D medications in 5 years that all of a sudden, granted, minimal,
Yeah.
under $10.
Depending on their LIS, right?
Yeah, so like granted minimal, but may face copays at the pharmacy counter for the first time in 5 years.
I've had this plan for 5 years. I've never experienced this before. Boom, call the carrier. What's going on? Why is this not working?
Absolutely.
Ding.
Huge compliance risk.
Yeah.
In a world where we already know compliance metrics are on the rise, like they are creeping up industry wide. That I don't want another 2021 where we see complaints jump from 16,000 to 41,000 and that trigger congressional hearings and new regulations and more hurdles for agents to cross. So use some time to develop communication plans, get in front of these clients. Same thing with premiums. We've got so many plans that are going from zero premium to having a premium. Those are all compliance risks. If someone just rolls over
2
in their
months in,
plan,
non-payment. We just got that number. I know
Absolutely.
WellCare, for example, we just heard with their PDP plan adding a premium now. It's 2 months of non-payment is
Yep.
how long a client can go before their plan would get terminated there. I would be willing to bet, based on the agents we talked to, a large number of these $0 plans have
coupon book.
but yeah, I would say chose paper bill for everything
Mhm.
there and do not have banking information on file for carriers.
Absolutely.
That is going to have to be resolved. Again, the PDPs are such a widespread one that we have, but yeah, I mean, we're seeing it return on,
Yeah.
in particular, some PPO plans
Absolutely.
on the MA side, but yeah, another reason to cause more compliance issues.
Yep. Yeah. So we've got some really great solutions for that we'll talk about later. But I think, again, premiums are a big problem. What we know in the Part D space is only about 30% of premiums are paid through Social Security deduction. So I don't know what part of the remaining 70 is bank draft versus paper bill. But given the prevalence of $0 PDPs over the past couple of years, I suspect there's a lot of paper billing going on just because why give someone your banking information if your bill is $0?
Yeah.
And I think that's definitely a clear agent mindset, a client mindset. Why mess with that? Let's talk for a minute before we jump into the specific impacts for this AEP on some of the levers that plans have. And really, I think that's the
lack
perfect
thereof.
lead-in, or the lack thereof, because I think that's going to show kind of how this market is going. So here's the cap that I want everyone to think about. There's a metric called total beneficiary cost, TBC, where carriers are not allowed to degrade benefits by more than a certain dollar amount every year.
So like $38
$38,
PMPM.
$40 per member per month. Now, what we know is a dollar is not a dollar. A dollar of dental is not equal to a dollar of PCP copay.
Right.
There's all sorts of fun formulas on the back end that carriers have to deal with and figure out. But that's kind of the ceiling they have to work with. They can't degrade benefits more than that TBC cost, so they've got to find a way to make the numbers work. They also have a floor of 85% MLR. They must spend at least 85% of their revenue on actual medical claims. That does not include administrative costs. That does not include agent compensation. That does not include marketing. That does not include a lot of these other expenses that are not directly related to paying claims.
And by the way, they're making all of these decisions usually in Q1 after or starting this conversation usually during the prior AEP while sales are still rolling in on the plan. Starting that, it has to be close to fully baked by April, I believe, is when they're actually filing those plans.
April, so like must be filed by the first Monday in June typically, and it's a pretty quick timeline, and you're working so far ahead. We taltalked about star ratings a minute
without
ago.
knowing anything of your competitors. Also, you don't see your competitors
you're
at all.
You're
doing this all in a vacuum.
I mean, like you know the floor because they have the same floor you do. They can't degrade benefits,
but you don't know who's going to decide to pull that plan. You don't know who's going to go non-comp. You don't know who's going to add a premium. You don't know any of those things.
Yep.
Or where they're going to adjust.
Absolutely. So now that let's get out of the dark. Let's
Yeah.
talk about this AEP, Matt.
Yeah, so this AEP, I think, kind of tying a bow on some of these changes, a few things that are going to be very widespread and prevalent. You've been under a rock if you have not seen that PPO plans are clearly being
Yeah.
discouraged heavily by carriers and the push for HMO right now. We're seeing, to your point of like the levers they can pull. One of the last remaining levers that was available to a carrier by the time we get to this part in the year. So again, they filed that plan, they degraded benefits, or if they couldn't degrade benefits enough, they did service area reductions. So
Yep.
we have seen huge numbers of that. Don't have a complete list yet, but I believe that number is projected to be somewhere around 2 million
Yeah.
on service area reduction this year. So even bigger than last year is what we're predicting right now. We're seeing that from a lot of big national carriers too. We're seeing a lot of carriers choose to go non-commissionable on the plans that are remaining in market. So if they didn't, so again, degrade benefits first step. If they couldn't degrade it enough, pull it all together. If they didn't pull it all together and they think they can make it work, now they're looking at it going, okay, if we're worried about this being profitable, now that we have seen a little bit of what the competition is doing, if we're looking at this going, man, this plan was really dicey, whether we were going to be able to be profitable or not. Now we look at the rest of the market and we are clearly head and shoulders above everyone else here. Oh, by the way, also agent commissions went up 10% this year, which is more than they ever have in a single year. And we didn't know that when we were filing our plans at the beginning of the year. Okay, maybe we can't afford to pay that. So we're going to pay a reduced commission level on this PPO.
Yeah.
Or maybe we're
Or
just
no
not going to pay
commission.
commission at all on this plan.
Well, and
So
it's
that
such a cascading effect. We're seeing in certain markets where, obviously, like there's what, right, wrong, or indifferent, there's what some carriers might think of as bad risk floating around. We've got a block of business where we've got people on this plan. We can't make it work. We can't reduce benefits enough within the TBC threshold, even if we cut comp. Like the plan doesn't
Right.
work financially.
We
It's
cut
a bad block of business. So if you're a carrier and you've got, like most carriers do, 2 or 3 plans in the market, and you're looking at this block that you have classified as bad risk, like there's no way we can salvage this. You're going to pull that plan from the market. So what happens? Well, now you've got to look at, okay, how do we avoid bad risk on these other plans that may be scraping by,
right.
hanging
Especially
on by their fingernails.
especially if there's a lack of competition in that market.
Absolutely.
And you cut your number one plan that had lots of things going on, but now your plan's number 2, 4, and 5 in the market also, and plan 3 just went non-commissionable. Oh crap, all we're doing is moving all that bad business into a different plan that we're going to tank.
Exactly. So now all of a sudden we see this cascading effect where as more and more information becomes available, if we have a competitive market like that, well, one plan's non-commissionable, one gets pulled from the market, and then that cascades down and more plans become non-commissionable because no one wants that bad risk. And from a carrier perspective, all plans paying comp or no plan paying comp kind of creates the same risk profile.
100%.
The business is going to spread
It's
the
just
same
you
either
don't
way.
want to stand out.
You don't want to stand out.
100%.
So
where you say it spreads, I totally get that.
Yeah.
Because I mean, if you got 3 major plans in that market and you think our benefits look strong, but the others are in there too, like, okay, at worst, we're going to get 50% of the business here. We're better than them, on benefits here, but these other 2 carriers will take some. All of a sudden, one of those carriers goes non-commissionable. Okay, now one just dropped out. Okay, now maybe we're getting 60, 70% of this. Other plane goes non-commissionable. Oh, we do not want to be the one to take all of this on.
Yeah.
We've got to do the same thing.
We've seen this. We saw this happen last year already. We had the plan preview here where we looked at, certain states where a number 1 carrier pulled out of the market, a number 2 carrier started picking up more business.
2 weeks later, they went non-commissionable.
And then now you've got regional carriers that took on so much business that they're not even contracting agents anymore because they can't afford to take on more business. They can't even support it.
There are a huge amount of regional carriers that are either gone belly up since last year. We've got several that are in that category. Others that are fully non-comp and just absolutely pulling benefits like crazy.
Yeah, I mean, we had a plan in Georgia that just went into receivership not long ago. I mean, that's the first time in over a decade, as far as I know, that an MA plan has genuinely gone belly up in the sense that the state is taking over and dispersing the assets of a plan. That's a big deal.
Yeah. Lots of uncertainty in that regional carrier space for sure.
Mm-hmm.
So Going back to that again, expect huge amounts of service area reduction this year with that. And then, like we said, kind of this weird situation we haven't been in before of so many varying kind of buckets of commissionable plans.
Yeah.
Where before we've had, the majority obviously being commissionable. The last year or two, we've seen an increasing number of non-commissionable plans. It was still just it pays me or it doesn't pay me. Now we've got, and it was typically kind of carrier by carrier. You wouldn't have as much picking and
Yeah.
choosing of plans. Last year we saw that now where what carrier may have 5 plans and 4 of them are commissionable, one's non-commissionable. Now they may have 5 plans. One is non-commissionable, one is fully commissionable, 2 are
Sure.
reduced commission. You could really see a lot of different buckets. And again, we're seeing that a lot, in particular on PPO plans, seeing reduced commissions or no commissions. But even some HMO plans, we're seeing reduced commission, so a less than fair market value commission. Really, the only thing I think we're seeing consistently full commission is going to be SNP business,
Yep.
and again, more non-SNP HMOs than PPOs, but even some HMOs on reduced or cut commissions there. So that's a big piece there.
Yeah.
That push is really mirroring what you were talking about earlier with V28, with the risk adjustment there. Again, that's heavily favoring value-based care models and integrated care models for these carriers, and making fee-for-service Medicare for them. So think your PPOs, your open networks, much more difficult for them to be able to do, and to your point, kind of color within the CMS lines. So therefore, that's where we're seeing a lot of this push towards HMO and SNP, specifically integrated DSNP. That's, I think, the other thing to mention. You talked a lot about
Yeah.
SSBCI, but also these changes and the heavy incentive mirroring, getting very close now to an all-out mandate on only integrated DSNP plans
Very
in the
close.
market.
Yeah. Well, and I think there's a big push. We talked about HMOs a little bit. I think I would almost view this as a little bit of a market reset. Some in some ways naturally occurring, in most ways government induced reset.
Mhm.
But this almost like a stern reminder that Medicare Advantage was always supposed to be managed care, and getting away a little bit away from those PPOs, because it's really tough to manage care and manage costs if you don't even know what providers are going to be billing you, because any of them can
Yep.
pick up the phone and say, we've got one of your clients, we want to bill you, and you let them do it, because
Yep.
that's the point of a
And it's
PPO.
again percentage based, uncapped. You can't, you don't
Absolutely.
know.
So I think this big push, some of the transparency I talked about in the first section, looking at prior authorization, that requires a tight network. If you're a carrier that's looking at, we've got a strong mandate from the government to smooth out, make easier prior authorization. How do we do that? Step number one is a tight, well-rounded network. You've got to have strong provider relationships to be able to create a gold card program where they just get to bypass prior auth, or to say, well, we've got a strong, tight, well-founded network. We're going to remove prior auth from these services, which we're seeing a lot of
Yeah.
carriers do. So I think prior authorization is driving some of this change in how plans are administrated, if not the actual types of plans carriers are focusing on.
Yep.
Focusing on.
100%. Some more of the areas that we're in particular seeing the benefit degradation hit hard. Obviously, ancillary benefits. We've talked about that a lot. However, I will say that's been pretty targeted towards PPO plans. The
Mhm.
majority of HMO plans seem to be keeping the
Yeah.
ancillary benefits on there. What we're seeing be the lever that's pulled a lot more is the medical cost sharing. So kind of
Yeah.
surprisingly to me, but I mean, I know Deft has done a lot of research. Dental is one of the key drivers of people changing plans. So
And
uh,
we've seen PPO plans where the dental is just flat going
gone,
away.
gone. Yep.
And
Or
OTC.
100%. So where we're seeing this hit a lot across the board, hospital copays are going up. I mean, I don't
Yep.
think I've seen a plan yet that's not getting an increase in their hospital copay, either in the amount of days or the dollars per day,
Well,
or in many cases, both.
and let's talk about that for a second, because there's some really interesting math going on here. Let's think about original Medicare. You've got that med sup. You're paying, let's say you're a little bit older, you're in a GI state where rates are a little higher. Let's say you're paying $200 a month for your plan G, $2,400 a year. That hospital coinsurance that you're not paying, by the way, that Part A deductible, 16 and change this year. Don't quote me on that. $1,600. Now, there are MA plans on the market for next year
With more
four
cost sharing
hundred and $50 plus a day
for 6,
days
7
1
days.
through 7, 1 through 8.
Yep.
I've even seen.
Yep.
So now we're living in a world where you might have close to $4,000
Higher than an
in
original
cost
Medicare copay.
exposure. That's double the original Medicare cost outlay.
Yeah.
So if you've got a client that's scared of or concerned about taking on something like a high deductible G, taking on something like a Plan N even, there are places where it makes a lot of sense all of a
Yeah,
sudden.
definitely. Other lever we're seeing moved a lot is the drug costs. So seeing
Yeah.
deductibles almost universally returning to
Mhm.
plans. Very, very minimal plans that will have no prescription deductible for all tiers this
Yep.
year. And then those tier 3 through 5 drugs really being targeted with either, again, just a deductible being put back on or increased. I've seen a lot of plans with the max deductible, the I think 635, maybe six
Something like
something
that.
this
Yeah.
year. A lot of those with the maximum on them, and then seeing those actual cost sharing increase as well. So a
Yeah.
lot of not return, but adding co-insurance
Mhm.
on for sure tiers 4 and 5 pretty universally, and with many carriers tier 3
Yep.
also adding
Going to
co-insurance
co-insurance.
rather than co-pays on those, which while we know in practice doesn't always equate to a huge practical increase, it does scare clients every time because same thing we're talking about with
Yeah.
carriers. It's uncapped. I don't know what it could be. It could be a crazy number. So with that, I think we're probably going to see a lot more people exploring the option of the M3P program smoothing
Yeah.
provision. Because when last year you had a $47 copay on your tier 3 drug and a $200 deductible, kind of stings when you go to fill it for the first time of the year. But now if you have a $600 deductible and
Yep.
you've got 30% co-insurance, that's actually $200 for that drug. All of a sudden we're talking about something totally different between a
Absolutely.
250 and an $800 script fill. I think a lot of people are going to look at that and go, well, my cost cap is coming in now. I don't have the donut hole anymore.
Mhm.
Why don't I just spread this out over the year? So again, it's going to be questions that are going to
Sure.
agents, and it's going to be increased administrative burden on carriers as well to administrate that.
Yeah. Well, and I think carriers are looking at the M3P is a little more of an asset in some ways now because they have to administrate that no matter what. It's not up to them. They have to offer that to folks. And what we're seeing in their benefit design is what we know is, let's say 2022 pre-IRA, before any of this happened. We still had the donut hole, all of that. We know for a fact only about 10% of Part D folks even got to the donut hole. Only around 4% got through it to the catastrophic phase. Incredibly small number of Part D beneficiaries that had those really high expenditures. Now, with the $2,000 cap, we just don't have enough data yet because this is it. This is the first year. We don't have enough data to say how many folks are meeting that $2,000 cap. But I can tell you with the benefit designs we're seeing this year, it's going to be way more than 4%.
Yeah.
Way more. It's going to be so much easier to hit that in 2026 a $2,100 cap, but it's going to be way easier to hit that cap and to hit it faster.
Yeah.
So I would agree. I think they are driving folks towards a little bit of that revenue capture at the front end through the M3P. Now, how they manage that, how they manage any potential bad debt, I think we're
because they can't cancel the plan. That's one of the things they can't do for not paying
they
that, which
can't
is
cancel
crazy.
the plan, and if they can't cancel the plan, and if you've got someone who hits that $2,000 cap in January or February, which again, not going to be very hard to do in some
could happen.
cases,
Take a couple tier 3 or 4 drugs.
then it doesn't really matter if they get disenrolled from the payment program because they're already past that cap and they're not paying anything at the counter.
Yeah.
So there's a lot of bad debt risk there, and I think it would not be impossible if that number gets large enough to see the carriers really start heavily pushing Congress for some kind of relief. Because they really have limited ability to collect on that as well.
Okay. Last point before we get into some solutions, because I want to
Sure.
talk a lot more about the good that can come from this and what you guys as agents can be doing for it. The last thing I would kind of say just with benefits this year is, one, we are, keep in mind, this is only year 2 of a very tumultuous, high volatility market.
Yeah.
This is not the final form. Like, we are still seeing plan benefits change this year. We will see benefits change next year. What I would caution everyone of, more than I can put into words, is be very cautious in moving members quickly this year for benefit changes, because
Yeah.
if they have been happy, they've been in insert name of carrier's plan for the last 4 years and they've been happy with it. All their doctors take it. Everything works well in that. And their dental is getting cut this year, or dental is getting cut this year. That's a $30 or $40 solution to write them a dental plan to fix that, versus changing their health insurance, changing the company they work with, and having them go through a whole new process. Hopefully all their providers don't have issues with it. You guys obviously are reviewing that. But making this change only for that carrier to do the exact same thing next year and completely cut the benefits on that plan. All this to say, benefits that are here this year that you're seeing, if there's a carrier that's very clearly standing out above the rest, I think there's a very high likelihood it will not be in the same boat next year. So unless you want to set the precedent that every single year you're going to just move them to whichever carrier kind of stands out until things smooth out a little bit,
Yep.
I would really caution everyone as agents of not trying to flip every client to a plan that's marginally better, or again, if the hospital copays are a little bit different, unless they are meaningfully impacted by a drug they are actively taking that is now gonna hit them with a ton of coinsurance, or there is something benefit that they are very actively using that is getting pulled away. But losing OTC or having dental cut or things like that, I would just be very cautious of, because even if
Yeah.
a carrier stands out this year, very low probability of that plan not receiving similar cuts next year. Or if they get too bad this year, get too much business like we are talking
Yeah.
about, it might be gone next year. So
Well, and I think there's just such a strong argument for there's a lot of markets, not every market, but there are going to be a lot of markets around the country where there's not going to really be a better plan to move them to. You're just fighting for the least bad plan in the market from a benefits cut
yeah,
standpoint. You already put them in the plan that was the right for them last year. You're probably not going to find a plan that good again this year.
mhm,
So why fight over a few dollars here and there on a plan that changed benefits still downward, but maybe a little less downward trend? Leave folks where they are, especially if you are in a market with a lot of non-commissionable plans. Pretty much every carrier we've seen, as far as I know, is still going to pay renewal commissions,
yep,
and you're being paid to leave people alone this year.
yeah.
You're being paid to focus on A, new business, and B, focus on taking care of your clients in a meaningful way by covering their exposure. This is I'm getting ahead of us into solutions,
I was
but
I was about to make the same transition, I think. So yeah, I think where you were going, this jumps into what we've been preaching since last May, was
Yeah.
time, tech, and team are the solutions. This to me
Yeah.
speaks to time so heavily on that, of like, you as agents have got to value your time during AEP. We have a 7-week window
Yep.
that you have to take care of everything there. If in any way you can move some of that time spend outside of AEP in any way to help with that, for example, what we're talking through here, I understand you can't cover plan benefits, you can't do those things with your clients outside of AEP. But if you can be educating your clients now, whether that's putting out information, hosting seminars, anything like that, just informing them of like, the industry right now is pointing this direction. Like, there's going to be some volatility the next couple of years. My advice to you as your agent is probably going to be to stay in your plan that you're in if you're not experiencing big degradation right now. And we'll continue to monitor things, but like, there's a lot of things changing. If you're happy with what you've got, I don't want to disrupt that. If you can be putting that message out year round, that will help you, and that will pay dividends when you then get into AEP, where your clients aren't going to be like, wait, I don't know. I have to review. I have to sit down. I have to have my hour appointment with you this AEP for you to tell me to stay in my plan, versus again,
Yeah.
just trying to outsource that throughout the rest of the year. So time, I think, is kind of the
Absolutely.
first major thing there. I know we've ran the numbers on that of what happens if you cut your hour appointments to 45 minutes, or you cut your 45-minute appointments to 30, how many more people you can see during AEP. But tell us some of the
Yeah.
solutions that you're seeing with
So
our key accounts agents right now.
absolutely. So I mean, I think appointment time is always going to be a conversation. We all run probably longer appointments than we want to. Like
Sure.
I think a lot of agents have conned themselves into this idea that our clients really love shopping for insurance, and it's not fun. There's nothing about sitting there and discussing all of your health problems with someone that Yes, our clients love us, but at the end of the day, we don't know them that well in most cases. So we're discussing our deepest, darkest health secrets with these people, and we're spending an hour with them just for them to tell us that we're going to have worse benefits next year. Like, maybe let's shorten that process. I don't think it needs to
Totally.
take an hour because, yeah, like rough numbers, if you hate your life and want to work 7 days a week and never see your kids and spouse, you can see about 800 people during an AEP if you're running half-hour appointments and not taking lunch and working 12-hour days. So don't do that. Find ways to whether it's spending money now to save time or spending time now to save time during those 7 weeks of AP data collection, looking at how do I get those drug lists, those doctors. If only there was a solution, Matt.
Yeah, yeah. So on the tech front, really making sure that like I cannot fathom a world where an agent in the modern market could grow beyond, I mean, maybe 2 or 300 clients at most without having a tech solution to
Absolutely.
streamline that. So yeah, if you're not using what was known as Medicare Center is now Integrity Connect, or obviously there's other platforms out there. That's ours. That's what I would say is the best on the market right now.
Hmm.
But you've got to be collecting all of your client drug lists ahead of time. And when I say collecting, not having your client send you a list for you or your staff to key
No
in.
one should be bringing a gallon Ziploc bag to your office full of
No
pill
one in your
bottles.
office should be keying anything in. The clients should be entering that information. You've got links to send them. This is something I know I feel like I hear pushback on, like, oh, my clients aren't going to do that. They don't understand that. They don't have the ability to do those things. I'm going to kind of call out most people on that of you don't go to your doctor's office. No one goes to a doctor's office today without being given either a survey you have to complete ahead of time or an iPad as soon as you walk in, and you
Yep.
have to confirm all of your health information, review your drug list, enter all your things. And if you're new to that particular provider, you're entering all that stuff for the first time. Everywhere you go, every member is doing that now. No one is sitting
Yeah.
down with a doctor. They're not going to the front desk and having someone come sit with them and write everything down. They're expected to do it. If they can do it in all of those other places, the vast majority are going to be able to do it for you as well.
Yep. And if your clients have trouble remembering, maybe they only fill some drugs every 3 months, maybe they fill them every month. Here's the thing, they can call the pharmacy and the pharmacy can give them a printout of everything they filled that year.
Yeah.
They can get those records. They can hop on their Medicare.gov account. They can look at those records. So, like, there's a lot of easy ways for them to find their list if they're not sure, what the dosages
Yep.
are, or, if they use one of those pill organizers and they threw the bottles away. Like, there's still ways for them to get that list. So, using something like Integrity Connect, sending out those client sync emails, which you can do from the platform.
Yep.
These are not individual emails you have to send out.
No, you can click and so funny. Quick story. We had an agent last
Yeah.
year who accidentally sent it to their entire client list. They were just trying to play around in there and figure out what it looks like. And they sent the, the plan and roll link for clients to be able to sync and put in their information. And I think they said it was over half of their clients
Yeah.
that sent their drug list back in with zero prompting, zero. Like, again, this was an accident that was unplanned. So needless to say, they're using it again this year
Absolutely.
and are a big fan of that. But literally no indication, nothing to warn a client this was coming. Half of them sent their drug list back in.
Absolutely. And I
So
realize
if you can
it's
just have half your clients do it, that's
absolutely.
kind of where I was going to finish this point. It doesn't have to be a solution for 100%
Mhm.
of your clients every time. I understand you have some 80-something-year-old clients who don't have internet or who can't travel. Totally get that. There are ones who fit that. And yes, you will have to cater to them differently. But if half your clients can do that, how much time is that saving you? If you've got
Yeah.
1,000 clients, if 500 of them you don't have to key in drug lists for, how much time did that save?
Absolutely. You and the people that work for you are incredibly skilled at what you do, and what you do is help folks find the best healthcare solution for them that's on the market. You're not typists. Like,
Yeah.
that's not what you got into this business to. You didn't get into this business to
Be a
do data
stenographer,
entry.
yeah.
Yeah, like that's not why you got into this
Totally.
business. So find ways to use the technology like Integrity Connect, and if you've got an agency, Integrity Connect Plus that'll allow you to help your downlines with this process. This is going to be a great solution this annual enrollment period. We've got so many ways that we're going to be able to reach out and touch clients throughout the year.
Yep.
We've got to start doing that now, though, to prepare them for this new way of doing business. Clients need to know what's coming. A lot of them have already had ANOCs hit their mailbox at the time we're recording this. and a very small percentage of them will actually read those. Now, what we do know is it's going to be a larger number than ever before. Our friends over at Deft Research will tell you that we have a more activated consumer base
Yep.
than we've ever seen in the past. People that are actively shopping more and more and are looking for better information, trusted guidance, and you can be that as long as you're putting yourself out there in the community, out in the world, to make sure that you're searchable, findable, that people know how to get a hold of you. And I'm not just talking current clients, because current clients are great and we talk a lot about how to service those, but this is the number one growth opportunity that agents in the Medicare market have had probably since 2004
Yeah,
when the
totally
Part
agree.
D program came into existence.
Totally agree. And that's where that time piece really,
Yeah.
to kind of close that out. If you can maximize your time better than other agents, that will be
Yes.
the differentiator that will help you be the one to grow during all of these changes, as opposed to the ones who are going to lose. Those who cannot maximize their time are not going to get to all their clients. Hence what you mentioned last year, 1.8 million people losing coverage, 500,000 did not get a solution.
Yep.
There are agents who will be in that bucket, and we'll have clients who don't get solutions. If you can make sure that all of your clients get a touch point, whether that's video ANOX, whether that's group meetings, whether that's, just whatever mailings you're putting out ahead, or again, kind of conditioning your clients year round, you will then be in a position where you can be filling lead orders. You can
Yep.
be targeting some of these service area reductions. If your market doesn't have a ton of disruption, but 4 hours from you, there's a plan pulling out that has 20% of the market, you can go spend or send an agent there for a week where you can
Absolutely.
target some leads there to work over the phone. You can be the one to be more prioritized with your time and grow through these changes.
Well, and talk to your network as well. You know, a lot of you have built an amazing business through referral partners, through centers of influence, strategic alliances, whatever you like to call it. Talk to them. If you haven't already, they need to know what's coming too. Your local pharmacist that sends you 3 or 4 people a month is going to be inundated with questions, not just through AEP, but at the beginning of next year too, when people see these drastically shifting
Yeah.
costs. So talk to those partners and explain to them exactly what they need to do. You can set up your plan enroll link, your client sync account, have a little QR code that pharmacist can set in the lobby and direct people to if there is a need for them to get a plan review. There are ways to get that out there that are extremely low cost, extremely quick to do. Email it off to someone, say, hey, print this out and put it up in your lobby if you've got that kind of relationship. If you don't, walk in and hand it to them, explain what you do. There's a huge opportunity this year to find new business and actually spend your time growing, not just maintaining your current client base.
Most definitely. So moving from the time piece over to
Yeah.
tech, on the Integrity Connect front, again, artist formerly known as Medicare Center to agents. There are three main things, because we could sit here and this could have been an hour and a half just about
Absolutely.
Integrity Connect. So we got three areas we really want to highlight of, if you have not converted, if you have not, taken the plunge in general into a system like this, why you should either be converting to Integrity Connect, or why you should consider this if you don't have a solution right now. So first one I want to jump into here is what they call the tagging feature, where it will basically batch your clients. So picture this scenario. I'm sure many of you have.
Yeah.
We get here and we talk about how all these changes are happening this year. There's going to be huge benefit degradation, a lot of negative ANOC letters going to clients, etc., all of those things. In the past, you would have to compare your drug lists across all your carriers to figure out which plans look good. You got to look at the docs, make sure that they don't have something changing in their network. Got to go to all the individual carrier, first looks or carrier portals, review benefits. At best, maybe go to a Medicare.gov type solution and try to map out plans side by side. But you're not doing any of this until October 1st, when everything is out, is when you can start starting to do this. Then you have to go find your client list. Hopefully you have a good CRM and you know who's in every plan. If you don't, you're downloading that from carrier sites to then figure out, okay, who's in what plan. Then take a look at all that and go, okay, now who are the ones I need to prioritize? Who's really getting big benefit cuts this year that I need to meet with sooner? Who are the ones who are mostly stable? I can tell them to stay put. Or if you don't do those things, you're in the category of those agents we mentioned earlier that are going to be losing clients this year because you didn't prioritize them. That's the less great world to live in. Those are the agents who are going to be losing clients this year, or at best, retaining and not growing.
So I'm going to use a term here. And if you're watching this, you're either going to get excited or have a little bit of fear in your heart when I use this term. Either way, probably a great reason to call us and learn more about Integrity Connect. Plan grids.
Yeah.
So how many times over the past 10 years have we talked to agents that when you have a plan grid out, I need to know what the plan
I
grid
need to have
looks
all the
like for my
copays side by
market.
side. I need to know all the moops.
That is the biggest waste of time I can possibly imagine
Yeah.
for an agency. It really serves no amazing purpose. The idea, especially nowadays, we didn't talk a lot about this when we talked about the market, but especially with the market we are seeing right now, the idea that you will have a clear winning plan in a market is foolhardy at best.
Yeah.
There is just no way to clearly say this plan's going to be the winner in this market anymore. This carrier is going to be the market in this state anymore. The segmentation is getting amazing with these carriers, and it's because they want to deliver better care to the right people. They're designing plans around a particular client profile that they want to serve, and that means a plan grid is worthless to you. Use the systems that exist. That's why we built tools like Integrity Connect, so we can utilize that on the individual client basis, and then looking at the drug list, the doctors, looking at it in real time to help you prioritize who to see. That tagging feature is going to show you here's the folks that are service area reductions. They're dark red or whatever color they're going to be.
Yeah,
this
so
year.
so it batches them
Stoplight
into
system,
batches them into, I believe it's 5 categories that it puts on there of like the prioritization based on how much change they're seeing there. So yeah, it will do all this work for you. If you have your whole client list in there, it will spit out your 1,000 clients and say these 80 are service area reduction. They will not have a plan at all come January. You got to meet with these. It'll give you a category 2, says these see really negative ANOX. Like, and by the way, this system learns, it's got AI enabled in there where it knows, looking at all of the information there and saying, hey, we're seeing members in this particular plan that are changing at a high rate. So your members probably will be as well. Or just look at their specific things and say, hey, this drug's now off formulary, or this drug that cost them $47 to fill last year is going to cost them $200 to fill this year. It'll batch that and say, okay, these category 2 clients here are very high priority, most likely going to change. Category 3, they got some degradation, probably need to shop. Category 4, minimal, probably don't need a ton, but like they did have some change. Category 5, looks like there's no better options on the market for them. They should probably stay put. Like that. You just open up you just open it up and it's there. You just have this categorization of your clients. Zero homework, zero prep time. It just batches your clients for you.
No,
to me, that is
plan grids.
No,
we don't need
grids.
A plan grid.
Again, to me, to be able to scale your agency, that is one of the most valuable features that is in there. And it's the only solution I'm aware of on the market that has something doing that right now automatically for you.
Yeah, no, it's an incredible solution. And it's, it's going to help you prioritize not just based on who is losing or degrading coverage. It's going to help you prioritize based on the flow of AEP, because hot take, service area reductions don't have to be seen during AEP.
Yeah.
Depending on your market and how much disruption you have, understanding that as long as you have good communication, I would never want a client to feel like they're not being taken care of, not being heard, not being seen, but explaining to them what those timeline looks like and knowing
maybe they're December 8th, 9th, or 10th appointment.
Yeah, you don't have to see them. By the way, AEP ends on a Sunday this year.
Oh, so
yeah, you've got the 8th through the 13th. It's the whole next week. To see those SAR
if it's not half your block, if you've only got a couple dozen of those, that'd be a great way to handle that.
Yeah, so using that to inform your decision making, and by October 1st, we should have a lot of that data. We're still waiting on carriers to upload data, get the data feeds going, but October 1st or shortly thereafter, we can really start working through how to prioritize that. Now, you may already have a lot of appointments with your clients set up already, and that is fantastic. Make sure we're using a tool like Integrity Center to get those scopes returned. Integrity Connect.
You were giving me crap about saying it wrong, and then you were the one to do it first. I have to point that out.
He does. Integrity Connect. Formerly Medicare Center. But so making sure we're using Integrity Connect to collect those scopes of appointment, to get those back in a timely manner. It'll track that 48-hour window for you. Or if there's a reason to not use that 48-hour window, we can uncheck that box and see someone the same day. So great tool to have. Lots of resources within Integrity Connect to streamline some of those, just like, I hate to say time wasters because they're all things that we have to do,
Yeah.
but things that up to now have
Non
had a pretty
yeah,
fixed amount of
non-profit
time that it
driving
takes.
activities.
Yeah.
Yeah.
And so, like, if we can take something that took 10 minutes and make it take 2 minutes, great. We just 5x our productivity.
100%. Next piece on Integrity Connect I really want to touch on is the AI call notes or call summary.
Yeah.
So, it has done call recordings now for the last three AEPs,
3
I
years,
guess.
yeah.
It was, when the mandate came out. That's continued to improve now where it's using AI to actually take those call notes for you. So the example that was given, Olivia in our office just came back from a training on this, where they literally had a situation where you listen to the call in real time there, and like one of the things that was mentioned was the client was like, "Oh, and I'm going to take Fluffy for a walk later." Like it literally took that information and added that into the pet name section for that client's profile and like added dog Fluffy. Like it not only is taking notes, like you're not just getting notes, it's definitely not the stenographer version. It's everything you need to know condensed,
Interpretive.
interpreted, and again assigned to the correct areas in that profile. So it's not just a text document that you're getting, it's updating that client's profile for you. So again, to kind of paint the scenario of the other way around, if you are anything like me, we do not have something like that we use currently for our calls. I hope we get to use something like that here soon. You'll end up at the end of the day, if you're like us and many people that work here, you go call to call to call, or for you guys, appointment to appointment to appointment. You probably a lot of times don't have time between those appointments to type up the thorough notes and update your CRM or update your profile the way you would like to. So you end up doing some quick shorthand, and then into your day, 5 o'clock, 6 o'clock, however late you're working during AEP hits. You've now got 9 different clients that you need to go in and update their profiles before you can go home for the day. One, it's a little less fresh in your mind client that you had at 10 a.m. as opposed to the one you just got done with. Probably don't have quite as vivid of a recollection of everything there. Not to mention, you'd probably like to go home, see your family, eat, do those things. You're going to be trying to get those done and in there. Again, if you're anything like me, I will point at myself. Sometimes the notes are not as thorough when you are doing them that way as if you were doing them while they're fresh in your mind after the call. Let the system do that for you and put those fresh notes based on what was actually said. And of note, you can do this for either a virtual appointment that's a call, or you can just have have it record an in-person meeting and it will do the exact same thing. So huge time saver. Again, I mean, I would easily say if you're running a full day of appointments, that's at least an hour of time saved. If you're talking 5 minutes, which I think is probably on the low end to type notes, you're saving at least an hour of your time every day.
Absolutely.
Just not having to do those.
And I would always tell folks, like with any system, any CRM, any tool, Integrity Connect is no different in the sense that it works if you do. If you do the work to set it up, get your clients uploaded, make sure that you can tag those notes to the appropriate profile, use it correctly, it will do amazing things for you. But I'm not going to for 1 minute say that you don't have to put in the work to get it set up and get it working for you.
The old tech adage, garbage in, garbage out.
Yeah, exactly. Exactly. So like get your client list, and oh, by the way, let's upload client lists today. There's no reason to wait for that. We can put them in Excel format, upload them in bulk, and then start getting those links out so clients can update their drugs and doctors and make sure you have all the data you need come October 1.
Yep. Last piece I think is touching on Integrity Connect Plus as a solution as well. So I know that's something we've long been, longing for to have a solution for agencies.
Yeah. I think the biggest development this year for us has been Integrity Connect Plus. We have been asking for and developing an agency solution with the artist formerly known as Medicare Center.
Yes.
An agency level solution for a long time, and Integrity Connect Plus is that solution where we're going to be able to allocate downline contracts where you can manage those LOAs. If you've got license only agent, you can look at, even if you have sub agents, you can allocate ways to manage those.
Yep.
Whether that's spreading out a lead buy across your agency or just being able to help track and manage clients and applications. Your admins can go in and look at that data and look for pending policies and unattributed calls and make sure everything's getting put where it needs to go.
Also see reports for RTS status, state licenses.
Absolutely.
You can see all of that for your downlines.
It's and
that's I was saying this is just going live before AEP. I know there is way more on the roadmap to come shortly thereafter as well.
Yeah.
Like this is a major focus and is going to continue to be a big differentiator.
Absolutely. I mean, the best is yet to come for sure.
Yep.
But going into this AEP, and if you've got an agency and you have 4 or 5 downlines, like time management is not just your biggest problem, it's your agency's largest problem. And using a solution like Integrity Connect to help manage that process for all of your agents is going to be really critical, because it's not going to just help you manage opportunities through things like the Lead Center platform and some of these other chances to spread that across your agency. It's also going to help you get an idea of, what are we missing? Do I have one agent that's just can't get over those 1 hour appointments, especially if you're in an LOA shop where you've got maybe 4 or 5 agents, but everyone just kind of sees who walks in the door. Let's make sure that everyone's getting taken care of. If you've got an agent with a book of business that's lagging behind a little bit, where can we plug someone else in? Using that data, using those insights to really fuel your productivity, fuel your growth as an agency is going to be critical this year.
Most definitely. So closing things out, I think the last piece we want to talk about is, so, we've gone through all the crazy things that are happening in the industry, what that will actually mean for this AEP, hopefully some good solutions of why this is a great opportunity to grow if you are following that right path there. Let's talk about where things are headed, with the best crystal ball that we can put together here of what do we think, next AEP and the following look like?
Yeah, I think, I hate to say more of the same, but I think we've still got at least another 2 years, maybe another 3 years of just really disruptive market.
Yeah.
We just do. There's still so much change. Even the Inflation Reduction Act, that's a 10-year impact. I don't think folks realize how long it's taking to implement some of those provisions of the Inflation Reduction Act. And it is really going to be that thorn in our side for a while as carriers learn how to navigate some of those cost pressures and changes over time. And towards the end of it, I think it'll actually improve the market a little bit as we see more and more drugs price negotiated and things like that. But over the next 2 to 3 years, more and more plan segmentation. Carriers know that it's not a market grab like it used to be. 10 years ago,
it's not a race to the bottom. Zero PPO,
no.
everyone in network. Everybody's got tons of, who can have the most dental. That's what's going to win.
Exactly. Well, and it's not just a grab for market share. It was, hey, we lived in a world 10 years ago where Medicare Advantage was, in the teens as a percentage of the market. It was 14, 16% of all Medicare beneficiaries. Now we're in a world where it's like 54%. Probably going to be higher after AEP, as crazy as that sounds. But we're in a world where it's a huge, huge chunk of the market, and we're not racing for more market necessarily. Carriers are looking at, how can I develop plans that better serve a certain population of beneficiaries? That's why we've seen a huge jump in chronic plans the past couple of years. That's why we're seeing this huge shift towards integrated DSNP plans. We're seeing so much work in, how do I create a plan that is just designed for certain types of people? And even in the med sup market, like, agents can't be a one-trick pony anymore. How many clients have you sat down in front of and say, well, you probably want to plan G, right? And they just are like, I don't know, you tell me.
That's the
what
only
we're
thing
here
even
for.
discussed.
Absolutely. So I think this idea that, we talked earlier, you're not going to have a clear winner in a market anymore for the MA side. You're not going to have a clear choice for the med sup side either. It needs to be a more intentional conversation. Your role as an advisor to your clients is going to be more important than ever.
Most definitely. Yeah, I think that's probably the biggest takeaway I would have, is that that role of the advisor is going to be more crucial than ever as the market gets more complex. I think that's going to create a situation where we have, potentially less competition. We'll have less agents in this space in the long term, whether that's agents who decide, they're comfortable enough, they've done this long enough, they don't want to make these changes, whether that's newcomers to this that, maybe weren't fully focused on it. They went, nope, not going to add this.
For sure.
Or some of the larger ones, some of the big call centers. I know we're already seeing.
Yeah, we've seen several close over the past couple of years.
Seen several close, seen several prioritize life insurance over the Medicare space. It's going to be a lot harder to train someone up in 2 weeks to get on the phone to compare all of these options than it was when it was, again, as I said, either year-round open enrollment on DSNP plans where it was pretty easy to find someone there, or just a zero premium plan with ancillary benefits. Like, a lot easier to get someone to sell that in 2 weeks than it is to go, Well, there's, 7 different MA plans in the market of various, different networks, different premium points. If we're talking med sup, we've got multiple things to consider. We got to talk about hospital indemnity plans and dental
I think
insurance. Like,
that's the biggest point I want to make is this idea that you like you cannot be a one product agent anymore. Like you
yeah,
just can't survive that
no,
way. You look at the rates of non-commissionable plans, whether it's the PDP side or the MA side, or even the med sub side with all these GI states adding on and commissions being affected there. It is no longer possible to make a living selling a single product. It's just too unstable right now. That doesn't mean 5 years from now we won't be in a super stable, bullish market again where everything's sunshine and rainbows and benefits are increasing every year. But for now, I think we've kind of hit the summit. And I think it
yeah,
was probably 2023
yeah,
as for in terms of benefit design. So
yeah.
you can't be a one product pony anymore. You've got to be offering cancer, hospital indemnity, final expense, annuities. You've got to be building out a portfolio for yourself and for your clients that can protect them year over year over year. Your clients should not be in a position where they have to shop for insurance every single year. You should have built a package of protection for them that says a $50 swing in benefits one way or the other doesn't bother them. It doesn't mean that people don't have to change because of doctors, because of drugs, because they move to a new state, something like that. It doesn't mean you won't have clients that need to change. But what we know from the baseline of years and years past is that number should be somewhere between 12 and 16%, not the 20 plus that we're expecting this year. A lot of people don't actually need to make that change.
Yeah.
They've just been conditioned to shop and change every year, and it's getting worse and worse because we're not building out that package of protection, that thorough benefits analysis that says how can we manage risk even in a changing market. And we do that with hospital indemnity. We do that with cancer. We do that with home health care. We do that with short-term care plans.
Increased
All of these
risk
other
from these
products,
products mean a need for
yeah,
other products to help fill those holes.
absolutely. And it's
Yep.
a need that was already there. There's just a finer and finer point being put on that need every single day.
100%. The last thing I'll say on that is, an opinion I heard recently on that was just how that can sometimes be a difficult conversation to have with your consumer when it's, hey, by the way, all of your benefits are degrading on this Medicare Advantage plan next year. My solution is you need to pay an extra 50, 70, $100 a month in additional coverage to help offset that. That can be somewhat of a difficult pill to swallow. My counterpoint that I made and that I would tell you guys is making sure that you are separating yourself from one particular plan or one particular carrier. You are not United Healthcare or Humana or Aetna or whatever carrier. You are their advisor whose job it is to put the best package together.
Yeah.
That plan's benefits changing was not your decision. What your job now is to make the best of that decision and provide them the best package. That package may have been a single $0 PPO HMO plan a couple of years ago, but that's not the case with the market that we're in right now. It may be, the case of needing to add dental, add hospital indemnity because your copays are higher, etc.
Absolutely agree.
Last thing I wanted to touch on really quick,
Sure.
Jalen, on these was you made a really good comment to me yesterday about how not thinking of this MA, market change as, oh my gosh, like we're headed into uncharted waters, but more of like a reset to what the market looked like 10 years ago or so.
Yeah, absolutely. So
I think
I
that's a
think
fantastic
it
point.
really is, and I think I said that earlier. Like this is a return to the idea that Medicare Advantage was always meant
managed
to
care.
be managed care. And if you look at, and I didn't get a chance, I told Matt I was going to pull the landscapes from like 2016 and
Yeah.
take a look, and I never got a chance to do that. But if we look back to like when I started in the industry, which was 2016, yeah, I mean, we had like one $0 PPO. We had a lot of premium PPOs. We had premium HMOs on the market.
Yeah.
We sure as
Zero
heck,
was not an assumption.
yeah,
by
we
any
sure
means,
as
and
heck didn't have any
definitely not for
$0
PPO.
drug plans. Like, I mean, even back then, the cheapest drug plan on the market was like $25. I
$3,000 or $4,000 a dental would have been unheard of.
absurd.
Yeah.
Absurd.
No, I was telling the example I gave was I remember it would have been from I believe it was 2015 going into 2016 that AEP. At that point, we had no $0 PPOs in the state of Missouri. It was all HMOs, which again, in many of those, like in our area here, the HMO was like $19 or $27. It wasn't even zero. But Kansas City, St. Louis, they had $0 HMOs, and I remember the first carrier that dropped the premium from their PPO. It was a $49 plan, I think, and it went to zero the next year. And we were like, oh my gosh, this is crazy. Like, I can't believe there's a
Yeah.
$0 PPO here. That was only, not quite 10 years ago that was unheard of to think a plan could do that. It's very quickly become the norm and they've gotten more and more invested. But to your point, like I think we reached peak benefit in
Yep.
2023 and we're seeing the market go back to resetting that. I think we will very quickly see a world where $0 PPOs will not
Yeah.
be very common. We will see a lot of premium PPOs. We'll start seeing some premium HMOs. I don't think zero is going away
Mhm.
altogether, but like it will be less the expectation. And because of that, again, making sure that you're in a situation, your clients are in a situation where they're expecting, to be shopping that, not expecting what's the best $0 plan. It's
Yep.
what's the best plan. It might be zero, it might be 19, it might be 79, it might be a med sup, it might be a high deductible plan. I don't know, but the expectation should not be, to what you were saying there, it was zero or it was plan G and a part D. That was kind of the
Yep.
two options for the longest time. I think we're going to see a significant more segments and ways to look at that. And I would advise everyone to make sure that you're setting your clients up for that expectation. Because I will also say, if you do that, it's going to make them a lot harder for someone who's not adopted, another agent who's not adopted that mindset, to take that client from you. If they're like, oh, you only have two options, like my agent told me about, all of these different ways to try to put something together.
Yeah.
I think it will start making those who don't look a bit archaic.
Well, and agents who understand the market, right? Because let's look at Medicare Advantage. I think so many agents forget Medicare Advantage was not designed to replace Medicare supplements. And I'll be first to tell you I stole this from a buddy of mine on LinkedIn. Medicare Advantage was designed to replace original Medicare. The intention was never that it was supposed to be the only thing someone had to
Hmm.
help cover their needs. It was designed to replace original Medicare, which was on that 80/20 basis. That's all it was ever designed to do.
Which most of us would never dream of telling a client original Medicare would be enough on its own.
Absolutely.
Yeah.
So Medicare Advantage was designed to replace original Medicare. If someone has original Medicare, we sell them a Med Sup, we sell them a Part D plan, we cover that risk. But if we sell them a MA plan, far too many agents think their job is done. There is still so much more risk exposure. There are ways to cover it. Now, I understand we may have some lower income clients, some D-SNP clients. They have tertiary coverage through Medicaid. Medicaid's going to pick up those copays and deductibles that are hidden inside that D-SNP plan, or they've got some kind of capitated payment model through integrated plans. But for our regular MA clients, you're not jumping from a $0 premium to 50, $75
Yeah.
to add on a hip, to add on a cancer. You're jumping from their what is anticipated to be $206.50 Part B premium to adding
Yeah.
on that 50 or
Totally.
$75. So understand one, better understanding what you're actually selling, better understanding the security you can provide to clients by asking one more question and spending 2 more minutes on one more application, and making sure that you're using that to really build a package of protection that can last multiple years. You shouldn't have to do this every single year. You can't serve more people if you're not serving the ones you have well.
Yeah. Very good. Well, I would say kind of my parting thoughts or summary here would just be the change is not going to stop anytime soon. The market is changing some. However, agents who adjust and who adapt are going to be very well rewarded over the next 3 to 5 years. There will be one, this market is going to continue to grow. There will be more
Absolutely.
65-year-olds for at least the next decade. So we are continuing to see the market grow. We are continuing to see all this disruption, which means opportunity for agents to, gain new members, take that over for someone who maybe is not adapting to this change quite as well. There's opportunity to gain members through service area reductions. There's
Yeah.
opportunity through acquisitions of these agents who maybe don't want to be in this business. There's no shortage of opportunity. I really push back against the sky is falling type rhetoric right now. These changes do make it difficult, but when there are difficult times, that is when the opportunity comes for agents who take them. When things are easy, everybody can jump in, which we saw. When things are less
Yeah.
less easy, that's when you really have to be an expert and when you can be the most rewarded from that. So I would that's kind of my summary there of like it's still a great time to be doing this. There's a lot of great ways to do it. Stick to your time tech team.
Yeah, no, I absolutely agree. Matt, we've talked about so many things today, and it would be easy for an agent to be really overwhelmed by all this information. But that's why you got a great team like ours at your back. Or if you're working with someone else, I'm sure you have a great team there as well. But give us a call. We would love to talk through if there's something here that was confusing or you didn't
Yep.
understand or you want to learn more. Give us a shout. Like I'm around more than I was all summer. It feels
Sure.
like I was on the road a lot, but I'm in the office now. It's Q4, and we'll be around a little bit. It's a great time, to look at what do I need to do better next year. There's still time for this AEP, but let's start building something that's going to last you the rest of your
Definitely.
career, not a one AEP solution like we have over the past few years. So I think let's end it with that. And thank you all so much for tuning in. Let us know if you have any questions, and we'll talk to you again soon.
Thanks, guys.